Hi students, in this video I am going to continue with the income statement and cash flow statement. So far we saw how to prepare income statement and cash flow statement until the investing activities. Now we will move further and talk about preparation of income statement and cash flow statement when we have financing activities. Okay, so when there is borrowed funds used in the financing of purchasing the capital equipment here, then another component which is financing activity comes into picture when we prepare the income statement and cash flow statement, or in other words, when we borrow funds from financial institutions to finance the purchase of capital equipment here in the investing activities or under the investing activities, then this component comes into picture and we have to include in the income statement and cash flow statement. So now let us take an example. Here where the out of the total 162,000 Newton required to finance the purchase of the equipment, 64,800 is borrowed. Okay, so the loan is to be paid in equal annual installment at the rate of 12% interest over 5 years, and the remaining 97,200 Newton will be provided from the company itself. So before we actually move on to the preparation of income statement and cash flow statement, first we need to find out the equal annual installment, which is nothing but uniform series. So we are required to repay the loan in equal annual amount. So because of this, this is a uniform series case, and we have to use this formula and find out the annual annuity value, and using this equation we get the equal annual installment at 12% equal to nil term 17,976.15. So every year, starting from the end of the year 1, we have to pay 17,976.15 nil term to the bank. So now, but in order to prepare the income statement, we have to include one component here, which is the interest under the expenses here. That is one. Another one is under the cash flow statement in the financing activities. We have to reflect the borrowed funds, which is 64,800, and also we have to calculate the principal repayment amount for each year, and the total of this interest amount every year and the principal repayment every year must be equal to 17,976.15 Newton. Okay. Now the calculation of interest amount is interest is charged on the principal amount that is left to be paid, or principal amount outstanding. Okay, so for the first year the interest amount is 7,776, which is the 12% of this 64,800. Okay, so interest for the first year is 12% of 64,800. So interest calculation is based on the amount, principal amount that is left or due for payment. So in the first year the principal amount left to be paid or due to be paid is 64,800 only, the borrowed amount only. So in the first year, since you pay a sum of nil term 17,976.15, from there, from that amount, 7,776 is included as interest, and the balance is balance amount is what we actually pay the principal amount in the first year. So out of the 17,976, 7,776 is included as interest and the rest of the amount, which is 10,200, which we get by subtracting 7,776 from 17,976. So this is the principal amount that we pay in the first year, at the end of the first year. Okay, so at the end of the next year or second year, the interest to be paid is 12% of the balance amount that is left to be paid, that is 64,800 minus 10,200. Okay, so the interest charged on the second year is the principal amount outstanding, which is 64,800 minus 10,200. Okay, so the interest charged will be 12% of 64,800 minus 10,200. So that will give you 6,552. Okay, so similarly for the third year, the interest before that the uh, principal amount paid in the second year is again 17,976 minus 6,552. So this is the total principal amount repaid in the second year after deducting the interest amount. So now for the third year, the interest charged will be 12% of 64,800 minus 10,200 minus 11,424. Okay, and the principal amount that will be paid in the third year after deducting the interest amount of 5,181 will be 17,976. So that will give you 12,795. And similarly for the fourth year and fifth year. Okay, so that is how it is calculated. Okay, and the rest of the things are same, so you can find out the taxable income and then calculate the income tax, then calculate the net income, calculate the net income by deducting the income tax from the taxable income. Okay, and the rest of the things here are same, and all other things are same, except that for the calculation of net cash flow here, you have to subtract these values, this principal amount which is paid to the bank. So the cash is here, the cash flow is outward, cash is flowing out of the company for paying the bank, so that is why it has to be subtracted from the total of these two. Okay, for every year similarly. So you can try this. Okay, please. Now moving on to the cash flow with inflation, income statement and cash flow statement with inflation. So the effect of cash flow, effect of inflation on the cash flows uh, or the income statement is because of the effect of inflation on these components. So for depreciation, there is no uh, need to uh, there is no need to uh, there is no need to take care of the effect of inflation because the depreciation expenses are fixed based on the government's rules and regulation. Also, the interest expenses are not affected by inflation. Once the interest rate is fixed, uh, the amount to be recovered by the financial institutions is fixed, and with the change in inflation rate, uh, the capital recovery by the financial institutions are not changed or is not changed. Okay, so once the financial institutions lend the money at certain fixed certain interest, then the amount to be repaid every year, which is in the form of annual equal annual amount, so that will remain fixed and that will not be affected by inflation. Whereas the investment in capital, working capital will be affected, so we need to take care of the change in the working capital requirement every year. So you can see one example here. So the inflation rate is given, and the inflation actually has an effect on the revenue. So revenue will increase by 5%. Uh, the labor cost will increase by 5%. Material, direct labor and material will increase by 5%, and overhead also will increase by 5%. So the effect of interest are shown here. Okay, so you just need to actually account for the inflation every year and calculate the income statement and cash flow. So in the case of cash flow statement, it will affect the salvage value. It will increase the salvage value by 5% and working capital also by 5%. Rest of the components will not be affected. So you can see here the revenue will increase by 5%. So you can see the calculations done here. So every year revenue is increasing by 5%, and the direct labor cost is also increasing by 5%. Direct material is also increasing by 5%. Overhead also is increasing by 5% every year. So I would like you to actually try and work out yourself. So the interest amount will not be affected, it will remain same, but because of the change in the values of all this, there will be change in the taxable income, tax and net income. Then the amount here will also change accordingly, and the salvage value will increase by 5% at the end of 5 years. Every year it will increase, and it will increase by 5%, and the increased amount is shown here. But please try yourself. Working capital also increases every year. So the initial working capital, that is 25,000, will be recovered at the end of the first year. But in the first year, because of the 5% inflation, the working capital will increase, and that will be 25,000 plus 5% of 25,000. It will increase by that much amount, which is 12,050. That portion will not be recovered in the first year, because in the first year the working capital requirement will increase by 5%, and this 25,000 plus 12,050 at the end of the first year will be recovered in the second year. But in the second year again, this 25,000, the working capital will increase over this 25,000 plus 1,250, by 5% again, which will not be recovered in the second year. So that will be recovered in the third year, and similarly in the third year it will increase, the working capital will increase by 5%, which is this one, and this will be recovered in the fourth year. And in the fourth year itself, it will experience an inflation of 5%, and it will increase the working capital requirement, which will then finally be recovered in the fifth year. So in the fifth year the project will be closed. Okay, so this amount, this working capital amount are cash outflow, so you have to deduct, okay, from the total of this net income and depreciation. And then this principal amount will not change, it will be same as I explained before. So that also needs to be deducted from the total of this 34,999 plus 23,143. From this we have to deduct 1,250 and 10,200, and that will give you this value, and similarly others. So I would like you to try yourself and do it yourself. So if you come across any problem, you can tell me. We can discuss on the Zoom during the online period. Okay, so I think I will stop here and continue in the next video.